just in the past 24 hours, it seems like we have another headline that hits the tape that impacts Bitcoin price, of course, to the upside. Goldman Sachs getting back in the action, reopening their crypto desk since shuttering it in 2018. Van Eck announced this morning they're listing another Bitcoin ETF on the CBOE.
I guess even Goldman Sachs has that FOMO, that fear of missing out. Obviously, Goldman made a commitment to cryptocurrencies, in particular Bitcoin, building out a trading desk in 2018. When they closed that down, that's not a small task. They had picked out some of their best traders, they thought, to staff that sort of situation. And then when you take that away from them, they kind of go to the back of the line, and maybe they even get shunned within the firm. So that's a big move. And to get back into it is also a big move. Kevin O'Leary and Marc Cuban both are now cryptoneurs, or whatever we want to call them. Marc was famously against it because he said it's not a currency. And I tend to agree. He said it is a store of value. It is an asset class, whether you want to call it digital gold or not. And you and I, Marc, are lucky enough to have embraced it through altcoins as well as Bitcoin, and even some of the exposure in the crypto, the stocks that are freely trading that are really exposed to crypto.
Money at the end of the day is really a social construct, right? We agree to exchange something of value, a juicy steak, a bottle of fine wine, a car, for oddly decorated pieces of paper with the picture of dead presidents on them, right? Why is that? It's because we've agreed since the abandonment of the gold standard that currency has intrinsic value. Is that not the same theme? Is that not part of what's propelling the institutional acceptance of Bitcoin and the crypto asset class? Or do you think there's other factors at work?
When they created Bitcoin, they set it up so that there would be just 21 million maximum, and we wouldn't reach that number for another 100 plus years from now. When you've got something digital like this, you have to make sure it isn't double spent. And that's what all these different nodes, known as miners as well, that's what they do. They're out there proving that Marc has not spent that crypto. You can trade fractions of it and so forth. But that fraction can never have been spent before. And that's what that process, that distributed ledger does. The Fed is rapidly printing money, the European Central Bank rapidly printing money, and that devalues those currencies. And so people wanted something that couldn't be devalued by government fiat. And there you have cryptocurrencies and decentralized finance.
But what is it that has gotten the institutions into the game now? And I'm not talking just about institutions in terms of financial market participants, but even corporates. You look at Tesla, Square, companies like that talk about allocating substantial portions, or 1% or more of their treasury balance sheet to crypto. What is different today versus perhaps 2017 or 2018, where we saw the last meteoric rise of crypto, led, of course, by Bitcoin? What's happening today?
I think part of it, Marc, is that you don't just need to have a crypto wallet with a Trezor. Now there are these multi-sig wallets, multi-signature wallets. There are people like PayPal, which has 270 million people on it through Venmo and PayPal. Then you've got Square with, I think, 80 million people on it. When big institutions like that make it much easier for Joes and Janes to get on, I think that's why the institutions really gravitated towards it, Marc, because then it wasn't just, crypto geeks. All of a sudden, it's a real asset class that you can store safely and that you can recognize the potential for the upside, because the entry isn't just a series of 16 different digits that you have to memorize or something like that. It makes the more easier you can make it, just like Steve Jobs did with Apple. The easier you can make it for a consumer to interface with it, the more rapid the adoption.
John, do you see that massive generational wealth transfer happening now? Do you see that as another catalyst of Bitcoin value to the upside?
Clearly, yep. And other folks, you and I discuss, Mark and I get to discuss things like this, folks, because we're working on at least one, if not two, Bitcoin funds right now. And we're working on that together. So when we look at things like, well, what are the drivers here? Is it FOMO, that fear of missing out? Is it institutional adoption? Is it the millennials that are, getting that wealth transfer that Mark talks about? It's all of that. And it's probably as well that people are looking for something that is borderless. I mean, literally, with my cell phone, Mark, I don't even need to have it on my cell phone, but you could have those digits up here. You can walk across a border. You remember in the old days, folks, when they'd ask you, are you coming into our country with 10,000 or more? And you'd say, well, yeah, I have, $10,000 in euro dollars and dollars, for instance. Not that I do that, but some people do. These days, you can cross borders with hundreds of millions of dollars.
Let's start with Bitcoin price, right? You guys had on a special roundtable yesterday with Market Rebellion, Renato, the chief investment officer from the famous Cathie Woods ARK investment. He made some rather startling predictions, or maybe predictions is the wrong way of putting it, comments about the ongoing allocation of corporate treasury to BIT. Can you share a couple of those with the Money Show?
Yeah, and the scary thing, Mark, was I think what caught your attention, it wasn't scary, but it was, I think you and I, of course, got excited about it. And for some people, they would just shake their head. But he talked about the difference, folks, between a 1% allocation of a corporate treasury and a 2% allocation, and how much bigger a 2% allocation is. Obviously, it's twice as big. But when we're looking at how few coins are actually out there right now, give or take, let's say there are 18 million coins, Mark. And you and I talked about this, with the slides. We don't need to show it, but just to give you guys an idea, there are 18.6 million millionaires in America right now. There are 46 million millionaires in the world. If every millionaire in the United States wanted to own a Bitcoin, they couldn't. If every millionaire wanted to own one, they could not own one. Why? There aren't enough Bitcoins yet. And there's only going to be 21 million of them max, unless by mutually assured destruction of wealth, the majority of coin owners decided, yeah, once we hit 21 million, let's double it up. Let's make it 42. Very unlikely that would happen, cutting their value, because not like splitting a stock. They would be saying the total supply of these, doubling it up or increasing it by any amount, would devalue the currency that's basically, or the asset that is existing, because it can't be devalued.
Corporate balance sheets, the S&P 500 put 1% that would justify of treasury in Bitcoin, that would justify a $100,000 price target easily. And if you went to 2%, this was a scary one. If you went to 2% of treasury in BIT, you'd be talking about $500,000 plus per coin. If you look, and this chart illustrates the institutional acceptance, all of the various events that have happened over the past year or so. We talked at the top of the show about Goldman getting back in the game, Bank of New York Mellon, JP Morgan, this ongoing institutional adoption, which always consistently, 100% of the time, and it's hard to say that in financial markets, 100% of the time, institutional adoption of a new emerging asset class drives price appreciation, period, end of story. So this is a chart that talks about price of Bitcoin relative to usage and demand. And maybe, John, that's a good jumping off point for a very important topic I want us to cover before we get back into some of the tips and tactics. And that is Bitcoin as a store of value and currency, right? And you touched upon that earlier. It's not a currency right now. It may be one day. It's not a currency right now. Now, it's saying the SEC's classification of it as a currency, which only serves to further confuse everybody. But talk about that for a minute. Talk about Bitcoin as a store of value and its own unique asset versus Ethereum and the rest of the list and the DeFi story.
And then you've got Ethereum, which, as Marc has kind of alluded to, is a smart contract that allows you to build other things off of that. And that one, by the way, has gone from $300 last year to $2,000 just 2 weeks ago, and now it's, I think, $1,500, Marc. So,
Bitcoin's in a class of one, and that was part of what I was touching on earlier, Jordan, where we were talking about Bitcoin as a unique asset and a store of value, and everything else, and I mean everything else, is a DeFi story. I like Ethereum. I'm invested in Ethereum. John's invested in Ethereum. We think Ethereum should be in a crypto and alt portfolio if you're getting into it. But Bitcoin is in a class by itself. There's the barrier to entry is virtually insurmountable at this point.
Excellent. And gentlemen, if they want access to your slides, is that going to be available at some point?
Yes, if you ask us nicely, I'm sure we'd be willing to email them to the audience.
We'd love to.
Thank you so much. Well, gentlemen, I want to thank you very much for joining us. I know both of you are frequent speakers here at the Money Show, and I know our audience really appreciated this discussion on crypto as it's extremely timely. And for the audience, I encourage you to tune in to all the upcoming Money Shows to see Jon and Marc and their appearances at their own events as well. Thank you both for joining us this morning. We really appreciate your time.
Thanks, Jordan. Say hi to Kim and Debbie for us.
We will. Thanks, guys. Stay safe.
And
We'll talk
Mr.
soon.
West.
Absolutely. We'll talk soon, guys. Thank you so much.
Take care, everyone. Thank you.
All right.
Thank
Bye-bye.
you.